In this video, I'm going to give an overview of the two most common types of life insurance and show you how to calculate how much insurance you actually need. Hey everyone, this is Michael Tortorich and thanks for tuning in. Just a quick note in the video before we get started. These videos are designed to complement my book, Running the Numbers, a step-by-step guide to life's major financial decisions. Each video corresponds to a chapter or section in the book, and the idea is to review the chapters and use these videos as a platform to add some additional color around the examples where it just wouldn't have been practical to do in the book. So to check out the book or additional videos, please visit my website at michaeltortorichfinance.com, and there's also a link to the website and the book in the description below. So life insurance is always a bit of a touchy subject because it requires you to think about your own mortality. And so people don't like to think about their mortality at all, much less as a major financial decision. And although uncomfortable, the reality is that we all die eventually, and you want to make sure that your loved ones are taken care of if something happens to you. So in this video, what we're going to do is take a look at the two most common types of life insurance policies, which are whole life and term life. And then I'm going to show you a couple of different ways to quantify how much insurance you should buy. Now, it's also important to note what I'm not going to do in this video. While I can give you guidance on how much life insurance to purchase, what I can't do is give any kind of guidance on how much it's going to cost. And that's because everyone is going to be different in terms of age, gender, health situation, where you live, how much insurance you need, etc. And all of those factors play a big role in determining the pricing. So with that out of the way, let's jump into some detail on whole life and term life insurance policies. So when people think of life insurance, they usually think of a whole life policy. And with the whole life policy, you pay premiums until you die, and then upon your death, a lump sum is paid to whoever you designated as the beneficiary. And because it's 100% certain you're going to die one day, the insurance company knows that they're going to have to pay out, and because that payout is certain, whole life policies tend to be expensive as compared to term life policies. A term life policy, on the other hand, as the name implies, is not until death but for a specific term. In other words, some specific period of time. And because the policy is not until death, there's a much lower probability the insurance company is going to have to pay out, and so it's usually priced much lower. And just to give you an example of what I mean, let's say you're 35 years old and take out a 30-year term policy. So the policy is going to expire when you're 65. Well, the insurance company knows that you're unlikely to die from a health-related issue by 65. And unless there's some kind of accident, the insurance company knows that they're unlikely to have to make a payout, and the pricing is usually lower as compared to a whole life policy. So when should you purchase a whole versus a term life policy? Well, if you think about it, when you really need life insurance, it's not when you die of old age, but when you die unexpectedly and still have significant liabilities. And so let me give you an example. Let's say you're 35 years old, have an outstanding home loan, and a spouse and a small child who rely on you for financial support. Well, you really only need life insurance until these liabilities are taken care of. And a term life insurance policy tackles this perfectly. And so what you can do is you can purchase a term policy for 30 years set to expire at age 65. And that's because at age 65, you expect to have a decent amount of savings to get you through retirement, the house will be paid off, and your kid, hopefully, will be self-sufficient and off the payroll. And so, in summary, at age 65, your liabilities are going to be met, and you won't really need insurance at that point. And again, assuming you're in good health, the insurance company knows that it's statistically unlikely they're going to have to make a payout, and so a term life insurance policy is really quite affordable. And so this leads to the next question, well, why do people purchase whole life policies if they're relatively more expensive? And so think of a whole life policy as a term policy with the added feature of tax-efficient estate transfer. And what I mean by this is, if you die with significant outstanding financial obligations, so for example, you need to pay your house off or pay college for your kids, it's going to act like a term policy, and your beneficiary can use it to meet those obligations. If you die of old age and those obligations are already taken care of, then your designated beneficiary will get a lump sum windfall, and Now, always check this with your CPA, but that lump sum that your beneficiary receives from the insurance company is usually tax-free. So think of it as you're paying higher premiums today so that your beneficiary can get money in the future tax-free. So those are the main differences between a whole and a term life policy. But there's one other feature that applies to both whole and term life that make just having a life insurance policy in general extremely beneficial. And that is the payout that your beneficiary receives remains outside of the probate process. In other words, it's not part of the legal proceedings associated with administering someone's estate when they die. Now, the exact probate process is different depending on where you live, but the process can be quite lengthy, and particularly if the estate is complicated. And the immediate payout on the life insurance policy can be especially helpful while the estate is tied up. And a common example of this is when someone dies owing significant taxes. Because that estate is tied up in probate, the inheritors may not have access to sell the assets to pay the taxes, or the assets may just take a long time to sell. In either case, the payout from the insurance company can be quite helpful to fund any immediate taxes or other liabilities due. So now that we've talked about what whole and term life insurance policies are and some of the differences between them, let's move on and look at two different ways to calculate how much life insurance you need. The first way is called the replacement of future earnings approach. And this method captures the present value of your future before tax earnings adjusted for any expenses that'll go away once you're gone. The second way is the needs-based approach, and this method captures the present value of the future needs of your family. So let's start with an example of the replacement of future earnings approach, and we're actually going to use the assumptions from the plumber example that we did in Chapter 9. So let's jump to Excel and take a look at the assumptions, and then I'm going to walk you through the calculations. And this spreadsheet can be found on my website, michaeltoldrichfinance.com. And here you can see we're on the replacement of future earnings tab. And starting in the top left of the tab, you can see the assumptions. And you'll notice that there are yellow highlighted cells, and these denote input cells. On every tab, there's an assumption section, and by changing any of the values in the yellow highlighted input cells, these calculations will update and flow through to the rest of the formulas. The first assumption is an expense decrease of $6,000. And the idea here is that if you're not there anymore, the expenses for your food, your portion of utilities, your vehicle costs, etc. will also go away, and as such, we don't need to replace that amount. The next assumption is how much longer you have to work, and we assume that's 30 years. Next, we assume general inflation will be 3% per year, and wage inflation will be 2% per year. The current wage is $54,221, and the effective tax rate is 15%. So now let's take a look at the calculations in years 1 and 2. So in year 1, the plumber is 28 years old. The current year earnings are $54,221. The yearly expense decrease for the first year is $6,000. And then you'll notice there's no line for taxes. As I mentioned earlier in the description, we calculate this on a pre-tax basis, so there's no adjustment for taxes here. And the reason that we don't adjust for taxes is because even though the insurance payout should be tax-free, we assume you're going to have to invest that payout to live off the returns, and then any returns you get from the investment will be taxed. So if we adjust for taxes now, you'll actually end up with less money than you need. So the net earnings in year 1 are $48,221, and then we have to discount those earnings back to the beginning of the year. So we then divide the net earnings by the discount rate, which is 1 plus inflation to the power of the number of periods, and you can see that formula here in row 9. And because we're in year 1, the discount rate is 1.03, which you can see here on row 10. And then you get a present value of year 1 earnings of $46,816. If we move to year 2, the earnings have grown by the wage inflation rate of 2%. So we multiply year 1 earnings of $54,221 by 1.02, and that gives us $55,305. Next is the yearly expense decrease of $6,120, and that's just the previous year expense decrease inflated by 2%. and that gives us a net earnings in year 2 of $49,185. Next, we calculate the discount rate, which is 1.03 to the second power, and it's to the second power now because we're 2 years away from the present. And that gives us a discount rate of 1.0609. And then lastly, we divide the net earnings by the discount rate, and that gives us a present value of year 2 earnings of $46,362. So you do this calculation 28 more times, and if we sum all those calculations up, we get a present value of pre-tax lifetime earnings of $1,223,571. So in summary, the future contributions that you would have made to your household from working has a present value today of just over $1.2 million. So now let's take a look at the calculations for the needs-based approach. And in contrast to the replacement of future earnings approach, where we're trying to quantify your financial contribution to the household, this approach captures the present value of the future needs of your family. And this is going to include any outstanding debts you have, such as a home loan, or future obligations, such as the cost of supporting your kids or a significant other. But then it also adjusts for any future earnings from your spouse, and also any financial assets you have, such as stocks, cash, etc., that can be used to offset those future obligations. And we're again going to continue with that example from the family of plumbers that we looked at in Chapter 9. And so let's actually jump back to Excel and take a look at the assumptions for these calculations. Here you can see we're on the Needs-Based Insurance tab, and this is the tab we're going to use to consolidate all the different financial obligations or assets so we can get a full picture of what the financial needs of the family are. And the first thing we're going to do is look at any immediate cash needs. And so for this family of plumbers, they have an outstanding mortgage of $300,000. They're going to have funeral expenses of $10,000 and credit card debt of $6,000. So their immediate cash needs are $316,000. The next thing we'll look at is any available assets they have that can be used to offset their immediate cash needs. And so here you can see they have $50,000 in an IRA. They have $15,000 of cash savings account, and a life insurance policy from their employer of $5,000. And so altogether, they have $70,000 of assets that can be used to offset their immediate cash needs. Next, let's look at the assumption for the family needs, and this represents the ongoing cost to support the child and spouse. And there are 3 parts to this: the spouse living expenses, the expenses for the child, and then the future income the spouse will earn. So let's start with the spouse living expenses. And we're going to assume the spouse needs $40,000 per year to live off of until they're 68 years old. And to calculate what the present value of that is, let's actually jump to the spouse living expenses tab. So first, let's go through the assumptions in the top left of the tab. So we assume the spouse will require 40 years of support. Next, we have general inflation of 3%. Next is the living expense inflation of 4%. And the reason the living expense inflation is slightly higher than the general inflation is because it includes health insurance cost. And as health insurance costs rise at a significantly higher pace than general inflation, and as these costs tend to make up a larger portion of living expenses, particularly as we age, we assume the living expenses increase at a rate slightly higher than general inflation. So lastly, we have the current living expenses of $40,000. And next, we'll take a look at the calculations in years 1 and 2. So in year 1, the spouse is 28 years old, and the current living expenses are $40,000. Next, we have to discount those expenses back to the beginning of the year. So we divide the $40,000 by the discount rate of 1.03, which you can see here in row 7, and you get a present value of year 1 expenses of $38,835. If we move to year 2, the expenses have now grown by the expense inflation rate of 4%. So we multiply the year 1 expenses of $40,000 by 1.04, and that gives us $41,600. Next, we divide the year 2 expenses by the discount rate of 1.0609, and that gives us a present value of year 2 expenses of $39,212. So you do this calculation 28 more times, and if we sum up all of those calculations, we get a present value of future living expenses for the spouse of $1,887,143. Now, if we jump back to the needs-based insurance tab, we still need to calculate the present value of expenses for the child and the future income that the spouse will earn. But if you remember, we actually already calculated this in Chapter 9. And so we know the present value of 22 years of child expenses are $495,002. And the present value of the future earnings of the spouse working half-time for the next 30 years are $584,722. So I'm not going to go through all these calculations again here, and if you want to see how we got those values, please see the link above back to the Chapter 9 video where you can review the calculations in detail. So if we add these spouse living expenses and the child expenses, and then subtract out the spouse's earnings, and again, we subtract this out because the spouse will be able to use those earnings to offset the future financial obligations, we get a present value of future family needs of $1,797,422. And then the last step is to combine the immediate cash needs of $316,000. We then subtract out the available assets of $70,000, and then add the family financial needs of $1,797,422 for a total needs-based life insurance amount of $2,043,422. Now we're just about finished, but I want to end this video with some advice. More often than not, if you have a non-working spouse that's taking care of kids, people don't consider life insurance for them. And the line of thought is usually, well, if my spouse isn't bringing in any income, then why do I need to get life insurance for them? And I want to challenge that, because if something happens to your spouse, I guarantee you that people aren't going to be lined up around the block to take care of your kids 365 days a year for free. You're probably going to have to pay someone to take care of them, or you're going to have to take on the duties yourself. And working a full-time job and giving the kids the attention they deserve with no help, it's just not realistic. Now, exactly how much you should insure a non-working spouse for, that's going to be specific to each family, and so it's really difficult to recommend an exact number here. But one way you could estimate the economic value add for a non-working spouse is to calculate the present value of hiring a full-time live-in nanny for your kids until they're grown. And that should give you a good idea of what you might want to insure a non-working spouse for. And so that takes us to the end of the video for Chapter 10. And if you liked the video, please don't forget to subscribe and hit the like button. And also stay tuned for my next video on Chapter 11, where I'm going to show you how to create a financial plan for retirement. And lastly, for more information on the book or additional videos, you can check out the links in the description below or my website at michaeltorrichfinance.com. Thanks for watching.